Greetings, it's time for another monthly update on world monetary creation, very similar to how we do every month. So for long-time viewers, there may be a fair bit of repetition, but we always have new viewers here, and the data does change from month to month. So as always, we go to the Yardeni Central Bank Monetary Report, the link for which will be in the description box below, and you can bookmark that URL because they keep updating the report every workday based on changes to it, but the URL stays the same. So the first step over here is cumulative monetary creation, money printing by the four major central banks of the world. These four central banks comprise about 90% of the world's money printing, not 100%, but these are the four big central banks that matter. And the US Federal Reserve is the red line. And as you can see, the US is not even the biggest money printer in the world in terms of total dollars printed. It's the second largest after the ECB, Europe. The US has done $8.9 trillion of money printing, which is about 1/4 of the total. So anyone who says that US money printing is going to cause a worldwide price commodity like gold to go up obviously doesn't know what they're talking about, because they are inherently assuming that the US is the only country in the world. Clearly, whether the US prints more or less has a very limited impact on the world's grand total, and the world's grand total is the only thing that matters because all technology is borderless, and therefore the deflation generated by that technology is also borderless, and money printing, which seeks out that deflation in order to nullify it, is also borderless. So the US can reverse its money printing, but if Japan or China or someone else is doing more money printing, then that negates the US reversal. Therefore, the only thing that matters is the grand total of all major central banks. And fortunately, we have that chart over here. This is the sum total of cumulative money printing worldwide, and it is $31 trillion. It began in 2007 and 8 with the financial crisis. That's when quantitative easing started in early 2009, and it has been rising on an exponential trend, as one would expect given the increasing diffusion of technology into the economy. As technological progress becomes more pervasive and the deflation generated by that technology seeps into more and more sectors of the economy, the amount of money printing needed to offset that will, unsurprisingly, rise exponentially as well, and this trend is already visible over here. So the question becomes, why would you ever reverse money printing when this trend reveals you are going to have to revert back to the trend line anyway? The world tried to stop money printing and even slightly reverse it in 2018 and 19, only to have to do more of it again than ever before. And now they are again trying to reverse money printing, unfortunately, and we are in the early stages of that, as you can see from the recent downward tick in this chart. And that is going to have the same disastrous failure that the central banks have engineered before, and they will be forced to print more money than ever before. And the dampening of this growth rate is already pretty pronounced. So we'll see the same chart in terms of percentage year-over-year growth. This is the same chart as above in year-over-year percentage growth terms, and in February of 2021 we had the highest percentage growth rate of all, 46% year-over-year growth. Now that offsets periods of negative growth as well, but this was well above the band that I thought was optimal cruising speed in terms of offsetting technological deflation and maintaining inflation of 2 to 3% a year. And at this level, even I thought there could be inflation, and that did not happen. There was not inflation in early 2021 of any aberrant nature. There is a little bit of aberrant inflation now, but that is because of a deliberate stoppage in production of oil and natural gas in the US, causing those two commodities to spike temporarily, and thus some current inflation. But that's clearly not because of money printing, and it's being incorrectly misattributed to money printing. The year-over-year money printing growth right now is only 6.7%. Only 6.7%. I have long said that the cruise control speed is 16 to 24% a year, and I said this even before this COVID spike, and that is in fact what the year-over-year growth rate has tended to be. Now that we're down to 6.7%, the next 1 year, 12 months, would have to have another $5 trillion just to get back to 16% year-over-year money printing growth. Another 5 trillion of new printing will have to be done, but now they are deprinting, they are reversing printing. They think they can unwind the balance sheet, and this is going to cause a major stock market crash, just like the last 5 times they tried to do the same thing, as I've spoken about in multiple videos on this channel. These are dangerous times we're living in, and the economics profession just refuses to get with the times. They have models that are based on mid-20th century assumptions. When reality conflicts with their models, they would rather ignore reality because their promotion, their recognition within their own profession is governed by other PhD economists who have memorized the same models, and therefore no economist really has the incentive or the courage to even consider that the models might be wrong. And they have a certain arrogance which leads them to think that only other PhD economists could possibly ever know what's going on. No one from the outside could figure things out, even though their own predictions have been wrong so many times. They don't mind predicting things again and again. They're always wrong, but that does not cause them to change their assumption. So then we scroll down further to see another country by country breakdown. You will often hear things of how the Federal Reserve has printed money and that is going to cause gold to go up and hyperinflation. We know that is not true because the US Federal Reserve, the red line here, is actually the joint lowest of the four central banks when measured on this chart, which is amount of money printing in relation to the size of a country's GDP. Now, GDP is an annual metric, and these lines are a cumulative amount of money printing metric, but the US has still printed only about 35% of its GDP, about the same as China. Europe has done twice as much. Europe has done 70% of its GDP. Nobody says Europe has high inflation or hyperinflation or anything like that. And the biggest one of all is Japan, which has printed 4 times as much money as the US has in relation to the size of its GDP. Japan has printed 134% of its GDP. And yet nobody claims Japan has hyperinflation. Nobody says Japan has a high CPI. So how can money printing be the cause of inflation at all? It isn't. As I said, and as I've spoken about in many videos on this channel, the stoppage of domestic oil and natural gas production in the US has caused oil and natural gas prices to rise. But all this is very temporary because the demand destruction happens faster and faster the more advanced the technomic medium of the world is. That could not have happened in 1973 when there was an oil crisis at that time. But now the demand destruction is so fast through electric vehicles, through advancement of other technologies to increase oil and natural gas supply, and even more dematerialized demand destruction, such as the telework revolution, which consumes much less fossil fuel than anything else. More and more people are working from home and they're saving a huge amount of driving, and that is happening the world over as well. So that's the reason for the current inflation spike. When it goes away, all the people who are screaming as though the world is about to end will be nowhere to be found because they never show up when inflation is actually low. Now, to show you how wrong those PhD economists have continued to be, let me pull up a chart. So in the 2010s decade, which ended on December 31st, 2019, the world had printed $23 trillion to date, which is also in the chart we saw a couple of minutes earlier. PhD economists still believe this would be reversed, that this 23 trillion would be reversed and everything would be normalized down to zero. They think zero is normal. They don't realize still that money printing has to be exponential and rising. So they believed that in the 2020s decade, that this reversal would happen. And that means a printing amount of minus 23 trillion. They were going to reverse $23 trillion of printing. Whereas on January 1st, 2020, I said that no, this decade would have $50 to $100 trillion of additional printing. $50 trillion if it is in the form of cash sent directly to people, which is the direction it must go, as I describe elsewhere on this channel. Or 100 trillion if they still do bond buying, which is very inefficient and non-diffuse, not nearly as pervasive as cash sent directly to people. And I write about that in my Atom publication as well. So what have actuals been as of April 22nd, 2022? Plus 11.5 trillion. So is the trend going in the direction they predicted or the direction that I predicted? And remember, this is exponential. If the first 2 years and 4 months of this decade have had plus 11.5 trillion, then we are absolutely on track to get to 50 to 100 trillion by December 31st, 2029. It's certainly not going in the direction of negative 23 trillion. That all these PhD economists, all these credentialed people in a subject that is decades obsolete, they all think this and they don't mind that they're all wrong, nor do they believe that anyone outside of their little ivory tower could know the answer. Remember, if reality conflicts with their economic models, then the standard practice is to ignore reality. These are hyper-theoretical people. Now, you hear a lot about inflation in the media because there's a brief blip largely tied to this war between Russia and Ukraine. It has nothing to do with central bank money printing, but the central banks of the world have decided to stop and reverse money printing in response, even though the inflation we see now is not because of them. That is going to cause a stock market crash. So what is the state of inflation really? For that we go to part 2 of this video. Now, those of you who are familiar with this channel know that I consider inflation to be not nearly the evil that it's made out to be, because inflation, in fact, is a fuel of technological progress, where the deflation is far more destructive, which is something you can learn about in this video up here. And the optimal amount of inflation, which I've described elsewhere on this channel, is for all three of these key metrics to be at 3% at the same time. So the U.S. Consumer Price Index, 10-year compounded annual growth rate, the Goldman Sachs Commodity Index, 10-year compounded annual growth rate, and the 10-year U.S. Treasury bond yield. Now, actually, this is a very low metric, because for the yield curve to have a normal spread and the Fed funds rate to be even 1%, the 10-year U.S. Treasury should be around 4%, but the symmetry of 333 is pretty good. So this is the easiest metric to meet in this age of technological deflation. So let's look at each of these three metrics in the manner that we do each month. First, the U.S. CPI. So we go to the U.S. Bureau of Labor Statistics website and we click on this little graph image over here. Now, in looking at the CPI, we take the most recent number and the one 10 years ago. So we take 288 divided by 229, 288 divided by 229. That is 1.257, so about 26% inflation in the last 10 years. So what does that come to in terms of a 10-year compound annual growth rate? For that, we take the 1/10th root of this. I hope everyone understands the arithmetic here. 1.023, so 2.3% has been the annual CPI inflation growth rate, 2.3%. So this is rising a little bit from earlier months. However, it's still a long way to go from 3%. And as we know, the recent inflation spike is only for one reason, which is that the oil and natural gas production in the United States domestically has been halted by the Biden administration for reasons that are very questionable. And it's not a partisan thing. Republicans have been on board with that as well. And that is causing inflation, which has caused an oil and natural gas exporting power, like Russia, to be more powerful than it was before, and to entertain an invasion that it wanted to do for a lot of years, but was not powerful enough to do before then, which makes oil and natural gas prices higher still. Of course, this attracts more technology to create more adaptations around oil and natural gas prices being high, such as demand destruction as well as supply increase, through more discovery, through alternative technologies, and some people not consuming gasoline altogether, more people working from home. $6 a gallon of gasoline is in fact a good excuse for work from home practices to continue. Now, speaking of oil and natural gas, we go to the Goldman Sachs Commodity Index. This is the Goldman Sachs Commodity Index, and by clicking on the 10-year number over here, you see the 10-year compounded annual growth rate. And that's 1.15%. So it's still nowhere near 3%. And remember, oil and natural gas are rising in price, but gold is still not rising in price. Gold is in fact a terrible investment thesis, as is proven again and again, because even when other commodities are rising, oil and natural gas namely, gold is not rising. So why anyone would think gold is a good investment thesis is crazy. That whole community is infiltrated by people who like gold for ornamental reasons and who like gold jewelry, but are not actually tracking the returns. They don't even talk about the returns. And then the few people who think gold is an investment thesis are commingled with that group. So there's not a lot of intelligent output in terms of the pro-gold investment thesis that is occurring. So the Goldman Sachs Commodity Index is 1.15%. And now we go to the third metric, which is the U.S. Treasury bond yield. 10-year U.S. Treasury bond yield that you can see over here, 2.83%. So it's risen a lot. It was 0.5% in July of 2020 and now has risen all the way to 2.82%. So more than 5 times as much of a rise. That is extremely bearish for the stock market for there to be this steep of a rise. It's also extremely bearish for the housing market because a lot of people purchased houses when mortgage rates were low, not realizing that home prices have swelled in proportion to those mortgage rates, and when mortgage rates go high, their home goes into negative equity. But as you can see here, this 3% threshold that I put forth in that inflation matrix is a level that is very rarely breached in the last 10 years. It was barely above 3% for extremely brief periods, and that always led to a correction back downwards because of stock market pressure. Now, if you go further back than 2012, yes, the 10-year yield was more than 3% for most of the 50 years prior to 2012, but that was a pre-technological age. That was not the atom era of exponential technological deflation. High-tech was too small a portion of the economy to cause distortion of these traditional metrics, whereas now that is no longer the case. So yes, the 10-year Treasury yield has risen a lot, and of the three metrics in my inflation matrix, it will be the first to cross 3%. However, this chart doesn't lead us to believe that it can stay above 3% for very long. And remember, the Federal Reserve is tightening. That's why it's even rising at all. The Federal Reserve is selling treasuries, even though the US government is also selling treasuries. When bonds are sold by the two biggest entities that can sell them, the price of bonds goes down and the yield goes up, and that situation cannot exist for very, very long. So now we go back to my inflation matrix and see how all three of these metrics line up in the scorecard. So the inflation threshold of 3% 10-year compounded annual growth rate of US CPI, 3% compounded annual growth rate of the Goldman Sachs Commodity Index, and 3% 10-year US Treasury yield, all three at 3%, all three are 10-year type metrics. What are we now as of April 15th, 2022? As we saw, the CPI is at 2.3%. The Goldman Sachs Commodity Index is at 1.15%, and the 10-year US Treasury yield is at 2.83%. So this is the one that's the closest to reaching 3%. Goldman Sachs Commodity Index is the furthest away, but it could cross 3% because it's kind of volatile. But the US CPI takes a lot to move the 10-year compounded annual growth rate. And yes, the CPI is currently high for the reasons I mentioned, mainly oil and natural gas, but that can cause a stock market crash, which causes those things to fall as well. So it's still a long way to go before this gets to 3%. And remember, 3% is not an alarm zone. This is where we want it to be optimally, because that's when technological progress is the fastest. The only thing that would be negative about it being much more than 3% across all of these metrics is that the poorest people are in fact suffering a fair amount. So even though technological progress would be even faster, that would come at a certain human cost. So I say 3% is the optimal cruising speed for rapid technological progress on top of the minimum amount of human suffering, as well as people who own mortgage houses making home equity gains. For a lot of people, that's the only net worth that they have, and inflation is in fact what creates home equity gains. Very few understand that. They would rather pay $1 less per gallon in gasoline but miss out on $300,000 of home equity gains, which exceeds the amount of gasoline they're going to pay for in their whole life. And I'll talk about that in other videos as well. But 3% is a threshold that is optimal, not high. And again, this time we know the inflation is not because of Federal Reserve monetary creation. It's because of deliberate supply restrictions on oil and natural gas production. So the correct response, even if it goes above 3% in all three of these cases, is not to stop quantitative easing. It is to stop restricting oil and natural gas production. And I'll talk about that in other videos on this channel that will emerge in the coming days and weeks. But anyway, I hope you found this to be informative, and this type of content gives you a more holistic understanding of these all-important economic and financial metrics. Thank you very much for watching.